Hello, and welcome to this week's PennEnergy News Update. I'm Hilton Price. China National Offshore Oil Corporation announced a bid on Monday to purchase Canadian oil company Nexen for $15.1 billion. The deal comes as somewhat of a surprise, as Chinese energy companies have been hesitant to target acquisitions in North America since the U.S. rejected CNOOC's takeover of American oil company Unocal in 2005. However, CNOOC has positioned itself well to complete the purchase of Nexen, offering a 61% premium on company stock shares, while also providing strong indications it intends to continue heavy investment in Canada. According to the Wall Street Journal, if successful, the purchase of Nexen would be the largest Chinese foreign acquisition since 1995. The U.S. Environmental Protection Agency announced it has completed its sampling of private drinking water wells in Dimock, Pennsylvania. Past data supplied to the agency had indicated the potential for elevated level of water contaminants in wells. However, after studying additional samples, EPA has determined that there are not levels of contaminants present that would require additional action by the agency. Between January and June of this year, EPA sampled private drinking water wells serving 64 homes, in some cases twice. As a result of the 2 rounds of sampling at these wells, EPA has determined that it is no longer necessary to provide residents with alternative water. The agency is working with residents to disconnect the alternate water sources. Secretary of the Interior Ken Salazar has announced that the Bureau of Ocean Energy Management will offer more than 20 million acres offshore Texas for oil and gas exploration and development in a lease sale that will include all available unleased areas in the western Gulf of Mexico planning area. The proposed lease sale is scheduled to take place in New Orleans on November 28th of this year and will be the first offshore sale under the administration's new Outer Continental Shelf oil and gas leasing program for 2012 to 2017. The sale will include approximately 3,800 blocks, covering roughly 20.5 million acres, located from 9 to 250 miles offshore. A new report being released by the Canadian Senate calls on the nation's energy industry to significantly reduce emissions of greenhouse gases. The report, developed by the Canadian Senate Energy Committee, highlights the country's steadily rising carbon emissions levels and suggests that lack of concern for environmental damage could eventually lead to economic consequences on the international stage. In particular, environmental groups are concerned about growing investment in Canadian tar sands, which hold potentially as much as 170 billion barrels of oil equivalent, but also require significantly more energy to produce because the tar must be heated up before it can be extracted. According to the U.S. Carbon Dioxide Information Analysis Center, Canada boasted the 7th highest carbon emissions in 2008 and the 15th highest emissions per capita. Despite stunning success over the past decade, the U.S. shale oil industry could see a quick decline if oil prices in the country fall much lower. That's according to Martin Craighead, the chief executive officer of Baker Hughes, who suggested to Reuters that many shale oil companies could be forced to slow or halt oil exploration and production if West Texas Intermediate crude oil falls below $80 a barrel. The benchmark oil price ended last week at $91.83 per barrel, well above Craighead's threshold, but also down 1.23% on the day as concerns about the Eurozone debt crisis continued to depress demand. In response to dropping prices, Craighead predicts many companies in the back-end oil field will need to scale back production. Thank you for joining us this week. For these stories and many more, head to PennEnergy.com.